Shreyash Devalkar, he's head of equity at Axis Mutual Fund. Johnson right now with his thoughts on the market. Shreyas, been a while, but good talking to you. Thanks for taking the time out. Neeraj here, good morning. I hope all is well.
Yeah, all well.
All right.
Good morning.
Yeah, thanks. So Shreyas, how are you, how constructive are you on the markets currently? The global view for people who have the options seems to be tilted towards this AI theme, and therefore Taiwan comes into the fore, US comes to the fore, India may not. But there are domestic measures that India has taken and domestic money that keeps on coming in. So for somebody who's managing such oodles of domestic money, how constructive are you on the markets currently?
The good part is two positive things, or two to three actually. One is, yes, as you are highlighting, over last 6 months, 1 year to 1 year period, India has underperformed compared to the emerging market. The flip side to it is that, yes, in last 1 year, because of this, the valuation premium of India, which used to be almost closer to 2 times compared to the emerging market, it has come to somewhere closer to 1.5 times. And to that extent, there is correction on the valuation premium of India compared to the emerging market. One. Secondly, on the growth front, already over last 6 to 8 quarters, we are seeing earning cut at a company level and overall index level as well. And with these earning cuts, already we are heading at, or we are looking forward to the growth of just single digit for this year. In my judgment, from here on, there may not be much earning cuts because already it has happened, and so lack of further substantial earning cut along with reasonable valuation, that is definitely a positive. On government side, definitely on the GST rate cut plus tax cut plus easy monetary policy, along with focus on infrastructure as well, which also has led to the better macroeconomic condition. I think this also lends a good comfort as far as investors are concerned. Yes, the valuations are high still, especially in the growth pockets. So what has happened is the pockets where there is a lack of growth, those pockets have got relatively corrected, and there the valuations are not demanding, or they are in line with long-term averages. While the pockets where there are themes, there is growth, the valuations are definitely high, and that's where one need to be very careful. If you observe a 3-year rolling return of large cap is closer to 15%. And 3-year rolling return of mid cap and small cap is closer to 22 to 23%, while our nominal GDP growth is closer to 10%. So in that context, large caps are heading to that level of 3-year rolling return, which is more acceptable. While mid and small cap, there has been 1 year of correction. I think few more quarters of correction or moving sideways. If that number comes somewhere closer to 16-17%, then even that case will look.
Shreyas, can I ask you, I mean, it's such a wide bucket, right? I mean, small caps, I mean, the MF rules would be the 250 first to 500, but I'm saying 251 onwards, everything is a small cap, right? So it's a very wide bucket. I heard you say quarters of consolidation. Are you saying the broader markets will keep on staying flat for a number of quarters going ahead?
Whether it is a quarter or so more, I was trying to drive a point at what kind of returns we are sitting on. So
Okay.
some back, the 3-year CAGR return in mid and small cap was closer to 30, from which after 1 year of consolidation, we are now at a 3-year CAGR return of somewhere closer to 20 to 23%. The growth rates of mid and small cap is in mid-teens. So that kind of number, when you look at as far as returns are concerned, then generally, historically, what we observe is the broad-based rally starts.
Okay. Let's try and put this into perspective, therefore. Market discounts things 6 months ahead. You probably discount them 9 months ahead as well, just the way you think. So where is it within this broader end of the spectrum, Shreyas? Because I hear so many people say there is safety maybe in the Nifty 100, but growth is in the areas which are the broader market spectrum, right? Because the new businesses are coming up there, so on and so forth. They're becoming large quickly, but it's starting there. Where is it that you believe there exists a combination of decent valuation, maybe not great valuation, but decent valuation, but long-term, strong growth prospects?
So what we are talking about it growth at a reasonable price, and
Exactly.
in this market where the growth is not broad based, you generally don't find such a pocket easily, and that's where you have to play for the turnaround stories, right? Where currently the growth is not there, while with some trigger or other, if the growth comes back in that pocket where the growth is established. So just to give an example, the established growth is there in power sector capex. Established growth is there in electronic manufacturing services and associated companies. It can be data center, its ancillaries. The growth is established in travel tourism related spaces, the hospital healthcare spaces. But it has for some time it has been in chemical space also. Now probably it is low, but broadly all these spaces where there is a structural story, actually CDMO space, there has been structural story. These spaces are really super expensive, where the growth is really established, and that's where you must have seen that over last 1 year the money was made, especially where there is a turnaround. Like auto was slowing down with GST. There is expectation that yes, the auto can revive and the growth may revive in some pockets of auto. And then you saw returns being made in that kind of sector. So that sort of thing, now the possibility where one can draw such possibilities is definitely with GST advent, probably auto or some consumer discretionary where valuations has not been that high. Second part is lending space. So lending space has got derated a lot, and with benign monetary policy, fall in the interest rates, there are some green shoots in that which we are observing. So some money can be made in those pockets where current growth is low, and that's where the valuations are reasonable. While if there is a turnaround, you can make more money out there.
Got it. Okay. Um, Shreyas, so thank you for identifying some of the buckets that you might be constructive on. The other thing is this consistent debate around the new issues, right? And today, for example, WeWork listed in a very flat manner, but we've seen tremendous subscription for LG because presumably it was priced well. How are you looking at the primary markets? Simply because we see a fair degree of participation from the mutual fund industry now in primary markets as well as in block deals.
Sure. So as far as primary market is concerned, if you see that with the correction in the market over last 1 year or so, or consolidation in the market, definitely now the valuations are getting reasonable in the primary market as well compared to the ask and demand a year ago or so. That's the good news. Secondly, primary market is allowing us now to participate in the newer stories which were not traditionally available. So just to give example, earlier it was after one lender, two lenders, three lenders, five lenders. Now, all of them are lenders, and there is no differentiation among the businesses as far as the investment participation is concerned. Today, if you see the companies which are coming are totally in different businesses, and where there was no opportunity to participate in the areas of business earlier, and that is actually sort of broadening the market. That is sort of allowing investors to participate in newer and different kind of stories rather than just sticking to IT and the lending space as such, and that has been the bulk of investment earlier. While today, if you see, it's right from defense to capital goods to all these electronic manufacturing services companies and the companies which are getting listed now, like in consumer durable. There was no large play earlier, and such developments are actually good for the market.
Okay. The focus towards consumption, Shreyas, given by the Indian government, starting with the Reserve Bank of India moves, of course, but then the whole GST cut. The notes that have come out seem to suggest that autos, at least passenger vehicles and two-wheelers, have had a fairly serious uptick since September 22nd. Do you expect that to continue? Will those sales numbers and growth therefore take care of some of the valuation upticks that have happened? And where within that bucket, whether autos, whether discretionary consumption, ACs, television, what have you, where is it that you are constructive?
Currently, we are constructive on spaces where there is a relative advantage which has emerged. because of GST rate cut, rather than taking a call that yes, it will just revive overall spend. So that call we need to just wait and be more constructive on that call after observing data points post festive season, because there has been some aberration in data point, as you know, that the sales was muted from 15th of August till the festive season start, and then after that it just started, and that's why these numbers are getting colored more because of the base effects and the postponement preponement. So currently our viewpoint is to look at the beneficiaries which are emerging out of the adjustment of relative GST rates, and because of which some categories may benefit over other, which is such products are available, or such opportunities are available in the auto space. Such opportunities are available in the spaces where even unorganized space was more, and that's where with the fall in the GST rate, then the differentiation comes down. So we are just looking at more such structural benefits rather than calling out as of now that yes, this will continue. We will wait for a data point post festive season ends and then take more constructive view on that.
Very interesting. Okay. Shreyash Devalkar, thank you so much as always for taking the time out and being with us, and to you and yours, festive greetings. Have a great time.